This short tutorial explains the relationship between the profit and loss and the balance sheet. A set of financial accounts opens with an opening balance sheet. The opening balance sheet provides a snapshot of the company position on the opening date. Here we say the opening date is January 1, 20X1. The company trades for a period of time. The profit and loss is used to present the financial performance of the company for the period. At the end of the period, the company prepares another balance sheet to show the position at the end of the period. The balance sheet prepared on January 31st is called the closing balance sheet. The opening and closing balance sheets and the profit and loss statement are referred to as a set of accounts. To demonstrate the relationship between the profit and loss and the balance sheet, let's take an example of a simple shop selling one product. The shop opens for business on January 1st. The shop owners purchase 1,000 units of product from a supplier for $2 per unit. In this scenario, the opening balance sheet shows opening inventory. Inventory is measured at the lower of cost or net selling price. In this example, 1,000 units of inventory are valued at $2 each, total 1,000. Continuing the example, in the month of January, the shop sells 800 units for $10 each. So the profit and loss recognizes a revenue from selling 800 units at $10 each. Thus, total revenue is $8,000. The company must now match the cost of goods sold with this revenue. The company matches the cost of 800 units with the revenue earned from selling the 800 units. The cost of 800 units is calculated by multiplying the unit cost of $2 by 800. Total cost of goods sold is $1,600. Profit and loss profit is calculated from the difference between the revenue earned and the cost of goods sold. Thus, profit is $6,400. This is referred to as gross profit. In our example, we do not consider any further expenses. A closing balance sheet presents a snapshot of the company position at the closing date of January 31st. The opening inventory on January 1st was valued at $2,000. The cost of goods sold for the month of January was $1,600. Hence, the closing inventory value on January 31st is $400. This tutorial demonstrates how the opening and closing balance sheet plus the profit and loss statement form a set of accounts.